today I'm going to talk about how South African SMEs or entrepreneurs or startups can access finance or funding through other means or through alternative funding. So if you run a small or medium sized business, or you're an entrepreneur or director of a startup in South Africa, you already know this truth, especially if you have tried to look for funding, even if nobody has said it to you clearly. So raising finance in this country as a startup or small business is not difficult only. When I say only, I mean it is very difficult, but that's not the only thing. Even if your business model is good, very good, you will still face serious hurdles. It is difficult because the financial system was never designed for business like yours, if I want to put it that way. Most SMEs approach banks with hope, or most innovators, most entrepreneurs, most startups, they approach the banks with hope that this is my idea. I need to go to the bank. You know what? If I put it and lay it out like this, I think I'll get funding. They prepare documents, sit across the relationship managers there in the banks and explain their vision, their growth plans, their market, and then they are told some version of the same thing that everyone else, especially if you're black, is going to be told. That you do not have enough security. You are coming from a disadvantaged background. Nobody, maybe family owns a house before, or ever owned a business or something like that. Yet the bank is not going to look at all these things that you have been explaining and all these ideas and this growth. The first thing that they'll ask you is, do you have collateral? Do you have something that they can call security? If we give you this funding and you fail, we can take this house, or we can take this building that is owned by your father's company, or things like that. Now, we know that most blacks, one, they do not have the house. Their parents most likely do not have the house at all, or they are in the rurals, or they are in the cuckoos and things like that. So there's no funding that this person is not going to get. The banks, in the current way they operate, they want to see collateral, which is in the form of land, in the form of property, in the form of a building, something of that nature, so that they can release the funding to say, if you fail, we get this car, we get this house, we get this. That's what they are concerned. If you don't have that, they won't be listening even to your proposals and things like that, and your visions and your plans and your projections. They do not matter, because banks in the current state, they operate in a traditional sense of the 1920s, a traditional sense of security and protecting themselves from risks of failure. And I don't know if it's by design, but this thing has not changed even after independence and things like that. So if you do not have a security, your business is too young, your cash flows are inconsistent, which is what a small business does. It's not going to be consistent. You're going to have one client now, you're going to have 4 clients in the next, you're going to have 10 clients, you're going to go down to 8. It's not going to be consistent income. So if your financials are not strong enough, then forget about the funding. This is the reality. And I'm sure most of those that have gone to the bank looking for funding knows what I'm talking about. So, and many business owners leave believing they failed. So because the bank is just going to tell you, if you don't have these things, then we can't take this risk. Well, how are we going to pay? We're going to lose and stuff like that. But I just have a great idea here. This idea maybe may transform a whole generation. But just because I don't have a property or something like that, or I'm 22-year-old, where am I going to get a property? Then your idea is going to die in the drain. Because in some instances, some ideas are not those that you can start under a tree or in a small corner. They really need some form of funding in the beginning, and then they can bear fruits which can transform a whole country or a whole province and things like that. So the ideas are different, and they are different stages. Imagine a candidate who studied engineering, and they have something that changes the whole water management system in the country. They can't start under a tree. They need funding to implement whatever thing that they've designed, which can think this, we can change this, and then it needs to go to be tested. It needs to be tested for safety, it needs to be tested for viability, for sustainability, for everything, feasibility, blah blah blah, all those things. It's not the same as somebody who has started a small business to sell fries on the road. They can start, but if they also still want to go bigger, they may need funding to at least get some places to rent which are bigger, and some utensils and equipment to fry at large scale and things like that. But you get what I'm trying to say. So there are some businesses that can start and it is going to grow, but there are some innovations that we will need to lose money in the beginning as a country or as a business. So you need to get funding up until this thing is established and can be tested and can be put into place. There are so many of that nature. So funding is very important for that person. And if they don't get this funding, then whatever their dream and whatever they've been designing goes to the drain, because their father didn't have a house that they can use as collateral to get this funding, or they didn't have a house, they are 22, or they didn't have a land to give, which is title deed. You can't give the land in the rows. It needs something that is title. They have title deeds to it. So the reality is this: traditional banks in South Africa do not lend on potential. They lend on protection, which means protection for themselves from the risk of losing. That distinction changes everything, because today's conversation or today's way of doing things is totally different now, and the bank needs to transform in that regard. So our conversation is really about understanding how finance actually works in the South African innovation or startups or SMEs environment, and why banks behave the way they do, and what alternatives genuinely exist for businesses that do not own property, do not have political backing, and do not have a 10-year track record for them to be considered. So, and before I even move to that, I want to also talk, because even though these banks refuse these people with the ideas, there are some few things that may be true that we may also want to look at why these banks reject. So just one or two that I highlight that will still be important even if we go to alternative funding. So to understand alternative financing, we must first understand why banks sometimes say no. These traditional banks, why they say no sometimes. So South African banks are usually structured around risk committees, capital adequacy rules, and these are some of them are really governed by the South African Reserve Bank, and also regulatory compliance. And this is something that still governs and still governs the way banks operate. And I wonder why some of this remains in place, especially when you have got a blank government for almost 30 years. So the bank's primary obligation is not to grow SMEs, really, if you look at it, the policy very well. It is to protect depositors' money and shareholders' value. So when a bank looks at your business and your idea or your innovation, they are not asking, is this business promising? Which I think they should, but they do not. They are asking, if this business fails, how do we recover our money? That's the idea. That's what they are looking at. So whether you come and pitch your idea for 2 hours, it doesn't make sense to them. They want to know how they can recover their money if they give you this funding and you don't pay or you fail. That is what collateral means, or that is why collateral matters more than ideas to South African banks. But this is a different thing to China or to US or to other things. They fund ideas by weighing their impact and how they can change situations for their people. So a small construction firm with the steady contracts but no property is considered riskier than a struggling company of, let's say, of a young guy that owns a mortgage building or a mortgaged building, or a building that they are operating in, a building that they were given by their grandfather. So I want to try to give you some context here. We have got a small firm, a construction company that was started by, let's say, a black guy. It has been operating, it is doing steadily well, obviously in a small nature. And we've got also a struggling company that is operating in a business that it owns, because this owner who is running it was given this building by their grandfather, because the grandfather was privileged, or they had bought it. Let's just not talk about privilege only. Let's say they had bought it and they are given to it. Although the way they may have bought it back then were relaxed ways. So, but that's what's happening now. This construction is doing well. It's actually having track records of money coming in, money going out, clients and things like that. This private company with this white guy, which is operating in a business that it owns, is struggling. When these two people go to a bank to get funding, the bank will refuse funding to this construction company, which is doing well with track records, with payments, with the clients, and they can actually show financials and things like that. They will refuse funding to that person. But when this guy goes to the bank with his struggling company, and because he has security, which is this building, he will get the funding. That's what we are talking about. You will get that funding. Why? Because they have security. They have the security that is needed for them to continue and for them to get the funding. Now, this is because banks want long proven trading histories, predictable monthly income, assets that they can liquidate in the event of failure. So most SMEs, especially black-owned, informal to formal, service-based or early-stage businesses, simply do not fit this model because they won't have these assets. I'm just trying to be truthful. It's not being personal. I'm trying to talk about what, in most cases, people meet with or are met with in the industry, especially black folks, because the market is actually not equal. It's actually not equal. That's the truth, especially when it's funding, because banks are operating on collateral. You don't have collateral, you are done. So alternative finance now becomes something else, and alternative finance exists because MSEs still need money, even though the traditional banks may have refused it, but they still need money. The small businesses, or the innovators, or the entrepreneurs and stuff like that, regardless of bank models. So because they need money to stock before peak seasons, depending on the industry, they need money to bridge cash flow gaps while waiting for invoices to be paid. They need money to invest in equipment, systems, or staff that can enable them to continue. And when banks refused to serve this segment at scale, then fintech lenders, private capital, and platform-based funders usually step in that regard. But here is the key shift. Alternative funders do not lend against assets. In most cases, they know you don't have. They lend against behavior and data. And that's where it can be beneficial now to a black-owned business owner or innovator or startup or entrepreneur. And for this reason, it is also important why I need to stress up that accounting becomes a central issue, or bookkeeping or accounting, financial stuff, because even though the traditional banks refuse you because of collateral, the alternative funding, even though they do not look for collateral or security, they also want to see viable options, viable ideas, viable strategies through numbers. So you need to be able to at least also show your actual data in your business. It may not be projections for the future like what the bank said, but it needs to be the actual true data that your business is getting. And for you to show the actual true data, you need to have proper accounting, proper bookkeeping, proper financials, and systems that can be shown to these funders to say, this is what is happening in my business, and they can make their decisions. So when an alternative lender looks at your business, they are not interested in your pitch or whatever you're going to say much. They are interested in your patterns in your business. they usually analyze your bank statements. So they're not going to say, oh, financial statements. Yeah, they can still ask them financial statements, but they want to see what's actually happening in your business. So bank statements can show us that pattern, not just balance in your bank account, but the flow of money in and out. The clients, is their interest? Are there people coming? Okay, so can we help this guy? Can we maybe advertise and invest in advertising? Can we get more people, get more clients and stuff like that? They want to see how money enters your account, how often, from whom, and whether it is consistent. For example, a small logistics business might not own trucks outright because it's small, but if its bank statements show regular payments from multiple clients or a number of clients month after month, that tells a story already of demand and reliability. So this thing that you are doing, it seems like there's demand, and if you can pitch it more and if you can advertise more, we can get more clients, something like that. Or a retail company, a small firm in retail might not have the property that it needs to operate maybe in different areas, but if its point of sale data, that's typing machines and stuff, whatever, or website data of purchases and stuff, shows stable daily turnover or purchases, low refund rates, and predictable seasonality, that becomes a form of collateral already to private funders. And they can be willing to fund you because they can see a pattern. But you can only show this because you've got proper accounting systems, you've got proper ways to show this data to the funders. So it's very important. Now, this is why many SMEs may still fail to access even the alternative funding. Not because they are unviable, they've got ideas that are unviable, but because their financial behavior is chaotic and invisible. So I'm trying to explain this because you will still need to show that you have this data. You can collect data. You have what what's happening. You can show what's happening in your business, that it is at least viable. So cash sales that never touch the bank account. So some of the characteristics that usually happens when your business is chaotic, you see that some sales happens via cash, and then that cash never gets banked into the business account. It's spent there. You're having personal and business money mixed together, personal accounts, transfers and stuff in the bank's business account. Everything is just happening haphazardly. You can't check whether this is a business expense or it's a personal expense. That's chaos, and you still need to avoid that. Even if you are not going to get money from traditional, you're going to get alternative. They want to be sure that this is money for your business. And there's no clear distinction between what is owner's drawings and business expenses and things like that. Your monthly groceries and your pay are within that account. Then it will be difficult still to secure funding from alternative sources. So you need to have proper accounting and still be able to do things appropriately, where you can now be able to get funding from private or from alternative funding which are not the banks, which are not traditional banks. So that will become unmeasurable risk, and even the alternative funding may not need want to be associated as well. The other good thing is that nowadays some of these funders or alternative funders do what they call revenue-based finance. It is one of the most important developments for South African entrepreneurs, startups, innovators, and SMEs. Is this revenue-based finance model. The model acknowledges a simple truth, that small businesses do not earn money evenly. You are starting, you are growing, so there's not going to be evenly income distribution. You're going to have maybe 2 clients now, 4 clients later, 5 clients at the end of 2 months, 20 clients at the end of 6 months, and maybe 50 clients at the end of the year, or maybe at the end of 3 years. So your income is going to be obviously changing. So instead of fixed monthly repayments, like what traditional banks do, to say you pay us this 5,000 to pay back our loan every month, even if there is no client that has paid you, because in business clients can take longer to pay. It happens. Now this model, the revenue-based finance model, we will say instead of that fixed monthly repayment, they can link your repayment directly to revenue. So when they sense that there's been a bigger revenue or income that has come, then they also now wants to be paid for the other month that things were lower. So it alternates like that. As your income is growing, it also, of course, they know that we need to run your business, but that's how they do. So when sales are high, repayments also increases. When they are lower, repayments reduce. That's how some countries do it now. So this is particularly relevant for retail businesses affected by seasonality, for hospitality businesses affected by load shedding or economic cycles, online and digital businesses, for example. And however, this funding only works if your revenue is visible, it is digital and traceable. They can be able to trace it. That's the other thing. They usually, but you can still negotiate with the alternative funding options for this. So if your sales are mostly cash and informal, this option will not work, or they may not allow that option, because the business is difficult to predict when there is cash. If you are receiving some cash in your hands and not via the bank account, how can they trace? So that's the other thing. So that's why I was saying data is very important, and to show that what's happening in your business via data is very important, even if you're coming for the alternative funding. So here is also the uncomfortable part that many business owners do not want to hear. Your accounting records are not just for SARS or for reporting and filing with SIPC and stuff like that. Your accounting records are actually a form of financial identity for you and your business. Because when SMEs say, I can't get funding, what lenders often see is you don't have clear income, or there's no clear income trend in your business. There's no data. There's no expense discipline. No reliable financial reporting. So this does not require complex accounting, what I'm talking about. It just requires consistency on the honesty and just taking data as it comes and preparing to show what's happening in your business. So a simple, well-maintained set of records beats a complex, poorly managed set of records every time. So I'm not talking about something very complex. A simple accounting system that helps you will be enough for you to be able to get the funding that you want. You can't be mixing your accounts, your business accounts and personal accounts in there, and then you want to go to a financing or to a funder and wants them to fund your business when things are chaotic like that. So even though we are talking about regional banks not doing the right thing, we also need to be truthful about you and what you need to do on your part to ensure that the alternative funders will give you. So lenders want to see that revenue is real, that expenses are being controlled or managed, that the owner understands cash flow. And accounting literacy is no longer optional in this case. It is a way of accessing capital. So how SMEs or small business can become funding ready in the real world. I've already spoken about some of these things, but I still need to stress out, because I need you to be able to get funding, even the alternative funding, especially when the traditional banks will refuse you because of security of collateral. So becoming funding ready does not start with applying for loans only. It starts with financial discipline, accounting, bookkeeping, tracking records and stuff like that. It starts with separating personal and business finances. Even if the business is small, it starts with ensuring all income flows through a business account. If you somehow receive cash deposit in the bank, but try to make sure that your clients pay via the bank straight away. There's no need to be dealing with cash anymore. It starts with understanding that profit and cash are not the same thing, and managing both deliberately is important. We have a video that we've done on that issue alone. When SMEs do this consistently over time, funding becomes a conversation with the funders and not a rejection letter like what traditional banks usually do. So the truth is that the South African market is not fair, especially for startups, for innovators, for entrepreneurs that are in these SME spaces. But on the other hand, you can be able to predict what is happening in your business, and that should be able to unlock some funding for yourself. Banks, traditional ones, protect themselves, but alternative lenders follow debt or follow data. They want to see what's happening in your business, and then from there they can decide whether they can give you funding. and things like that. If you want access to finance without some security, some property, some building, your business must speak through its numbers before you speak through your words to convince them. The business that survive are not always the most brilliant, really. They are the most financially disciplined, actually. Those are the ones that survive. That is it. And I hope this has been helpful, and I hope you've learned something that helps your business. And please, as usual, subscribe to this channel, follow and share. Thank you.